Hey Eric, how are you?
I'm good, Ed. How you doing?
Good. We got a nice sized audience today, about half the usual crowd, so I guess a lot of people are on the road. We have a special guest today. I have four of these King Charles Cavaliers, and this is Cooper. Cooper's 9 months old. She's a real cutie pie. And of course, Max is doing his usual thing. I thought instead of waking him up, given that the holidays and he should be a little bit more sociable, I just introduce you. Though I think you have seen her kind of wandering in and out, but she's a good little girl. Where's your dog?
He's sleeping over by the door.
Okay, it's amazing how they sleep. But again, the only problem I have with Max is when I'm working and he's back there snoring, it kind of lulls me to sleep. So I have to kind of stand up and wake myself up. Where are you located today?
I'm in Manhattan right now.
Okay, good. Yeah, I'm in Long Island, and as you can see, we may have a white Christmas after all. At least there'll be some snow left. We had snow a couple of days ago, so that I think it was actually a surprise. But anyways, it's cold, so the snow's going to be hanging around for a while. Um, Eric, what are your plans for Manhattan? You're going to go back to California at some point?
Yeah, I'm going back to Jersey after this actually, and then
Okay.
flying back home on the 27th, back to
All right.
sunshine, thankfully.
Good. Well, lots of things to talk about, and I thought we'd make this kind of an informal session since it is the holidays, and I guess we should have both had a little wine here just to celebrate the fact that the year is almost over and we got through it, and it was a terrible year and it was a great year. I mean, it's kind of a whole mix of things, and I'm kind of thinking that maybe we should think that things might actually go pretty well up ahead here, but we'll see. Meanwhile, we spent a lot of time talking about the economy and financial markets, and therefore we're always talking about the Fed. I don't know if you saw that this morning, but Elon Musk, I think, tweeted that he thinks there's too many people working at the Fed, and that would be a good place to start cutting. I'm wondering how he plans to do that. Is he going to start from the bottom up, or is he going to start from the top up and say, these are the most expensive people, starting with the Fed chair and the people on the FOMC committee, and maybe we have to cut them out and let everybody else do it. Eric, I am actually going to send Musk a message that you and I would be more than happy to outsource the Fed. We'll do it for half the price. Whatever the Fed costs, we don't, we're not going to be quibble about it. We'll do it for half the price. But I've observed, and I think I observed in my book, Fed Watching for Fun and Profit, that they do have a lot of people working for them. They got just at the Federal Reserve Bank in the Federal Reserve Board down in Washington. I think they've got over 300 PhD economists, not just focusing on monetary policy, but on microeconomics and all kinds of other things. And then there's all these other Federal Reserve branches, these district banks, and I keep watching some of the stuff that the Federal Reserve Bank of San Francisco puts out, and it's pretty wokish kind of stuff. A lot of stuff on climate and diversity and all that, which is fine, but that's kind of raised the question of what's the Fed doing getting into all those subjects. And the answer is they always seem to be able to come up with some justification for doing exactly that. Eric, now that I've sort of given you my 2 cents on the latest about the Fed, how about giving us 5 cents on what happened last week with some of the Fed officials? Here, Powell kind of tried to get the market to accept the possibility that there would only be two instead of four rate cuts next year. And then what happened?
Yeah, it's kind of crazy. As soon as Powell wanted to deliver that message, the two like biggest doves, hit the media. We had Austin Goolsbee and John Williams. Goolsbee saying, we're far from neutral. We're still very restrictive. Williams still saying, we have more cuts to do. I don't know why they decided to do that. I'm not sure Powell's too happy about it, but it seemed like Powell wanted to ditch that, say, hey, the economy's
Yeah.
pretty strong, we know, and then there's definitely a lot of dissent or at least debate on the committee.
Well, Williams was basically your boss when you were at the Federal Reserve Bank of New York there for how long were you there? A couple of years?
Yeah, a couple of
Yes.
years. And I mean, I worked directly for Lori, who's now at the Dallas Fed. So, I have
Okay.
experience with both of them.
Okay. So correct me if I'm wrong, but Williams seems to have a big intellectual stake and bias in the neutral rate of interest. So is it possible that he doesn't want to be there? He doesn't want to believe that we're there. That he wants to keep this thing as a point of conversation in the next few FOMC meetings.
Yeah, I mean the vibe or kind of the atmosphere at the Fed was that Williams was so caught up on our star and didn't really care about markets. He really was like a hardcore academic economist,
Right.
and that's not what the New York Fed is like. It's very market focused, and it seems like
Sure.
he's stuck to those guns the entire time. He
Yeah.
really relies on his model.
I mean, he's written a lot of papers on the subject, correct?
Yeah, he like one of the main neutral rate models. His
Mhm.
name is on it. So
Yeah. And both Goolsbee and Williams more or less said that we're still restrictive. And I mean, what was the difference in nuance between Powell and these two characters in terms of where we are relative to the neutral rate?
yeah, I mean, I think they sounded like Powell did the previous few times he spoke in November, September, and Jackson
Yeah,
Hole, and they didn't get the memo that he was kind of shifting his tune. We had a good PCED report in terms of inflation falling, but
it was
I
good.
think all the Fed officials can see like service. Powell's now talking about non-market based core services, so stripping out the portfolio management fees. But I think they're worried. What if inflation's a little hotter in Q1? It was earlier this year. We had
Yep.
annual price resets, and you just don't want to claim they already cut for
Yep.
100 bips. Why claim victory right now when there's clearly some risks
Yeah, but
to inflation?
I mean, the difference in nuance, I think, is Powell. He didn't completely pivot, but he pivoted towards the idea that, well, now that we're down 100 basis points, we're clearly closer to
Yeah,
neutral. He was kind of focusing on we're closer to neutral, and Goolsbee and Williams were saying we're still a ways from neutral, and there's room to cut maybe more than two times
yeah,
next year, right? That the way you kind of read it?
yeah. We were kind of saying how when Powell was talking about neutral, it's kind of odd because you don't know where it is. But I think to him, at least, maybe we're there or close.
Yeah.
But Beth Hammock in her statement on dissent, mentioned it like she doesn't really see reasons for cuts. At least a few other members didn't see reasons. So,
Mhm.
who's to say we're not at neutral other than John
Yeah.
Williams' model?
Well, if the Fed really was data dependent, like we're data dependent, economy is doing fine. Real GDP is growing 3%. The unemployment rate's right around 4%. The inflation rate's getting close to 2%. So aren't we there? Aren't we at nirvana? Aren't we, at a level of interest rates that seems to be making everything happy? So why mess around with it? The other thing, Eric, is they seem to be totally tuning out any notion of responsibility for financial stability, like causing melt-ups in the credit markets. We've got what credit spreads, junk bond spreads extremely tight, is almost historically tight to treasuries, and then of course the stock markets was on fire. I mean, I almost got the feeling that Powell sort of understands that. He seems to have more of a market background, so maybe he was kind of cognizant that it was important to kind of calm the markets down about rate cuts. But Goolsbee and Williams, is Goolsbee a trained economist? Do you know anything about his background?
Yeah. I forget where he got his PhD, but he was a professor at U Chicago, but like a hardcore Democrat. I think he was either the chair of the CEA or on the National Economic Council for Obama, I
Yeah.
think.
The point
So
is they're both hardcore economists basically, and don't
yeah.
have much experience with markets. But you'd think they'd kind of catch up, and somebody would clue them that this is a lot more than an academic exercise. It's not like a lab experiment where, oh, good, they can now see how their models work.
Yeah.
That's really not the point. I mean, the point is really do no harm, do no harm. If I had the power to redo the mandate, I'd say the mandate is financial stability. I mean, everything else kind of falls out of that. If you can't maintain financial stability, and Eric, correct me if I'm wrong, when the Fed was set up in 1914, the whole idea was financial stability. The farmers had this annoying cycle where they needed credit during the harvest, and if they couldn't get it, the rates went up and created all kinds of havoc to the business cycle. So the Fed was really just supposed to provide an elastic currency, I think is what they called it back then. And somewhere along the way, the Fed got taken over. It used to be run by business people and by lawyers and maybe some politicians, but I think it's basically business people and bankers, I should say, not lawyers. And then somewhere along the way, the macroeconomists took over after World War II. The Keynesians took over, and it became very much of a lab for macroeconomists to experiment with their models. So here we are with what it is what it is. And I was thinking about it. Every now and then, I am inclined to think that maybe we should just figure out a way to do without the Fed. Maybe there's a way to let the markets kind of decide what short-term interest rates are, or at least have the Fed just responsible for financial stability and don't do anything until you have to create a liquidity facility to kind of stabilize the situation. But then again, I don't know what we would do for a living if there was no Fed, you know? I mean, look, we just, had some good content discussion here all about the Fed, but there's more going on here. And again, I think one of the themes that we've been talking about is it's amazing how well the U.S. economy does despite Washington. And speaking of Washington, we had another one of these. Well, I guess the government shut down for about 15 minutes or half an hour there over the weekend when they had to come up with a continuing resolution, and lo and behold, they did. Did you get anything out of it? I mean, what the press seems to be, some of the press seems to be arguing that this just demonstrates that it's not going to be too easy for Trump to get anything through. That sure he won a clear sweep, but now the reality is the Republicans sometimes can be their own worst enemies. You draw any conclusions from any of this, or we'll see how.
Yeah, I mean, I don't disagree with that. I think that's why a lot of the discussions being like, how much can the executive branch do on their own? Kind of surpassing Congress. It seems like a decent amount. So we'll see. But yeah, I don't know. Congress is so discombobulated these days. It was
Yeah,
kind of remarkable they couldn't get anything done.
yeah. It wasn't a good way to start because I had this naive impression that the Republicans themselves would get, the extremists, or the conservatives on the other side of the spectrum here relative to wanting to get things done. They just instead they didn't seem to get the message that I think a lot of people thought, including myself, that the election message was Trump got a clean sweep, but now the popular vote, the electoral vote. So he basically got a mandate to pursue his policies, and the Republican instead of the Democrats saying, wait a second. I mean, the Democrats clearly are saying, wait a second, but um, the problem would be, of course, if the Republicans kind of split up. And I think that kind of happened in Trump 2.0, didn't it? I mean, 1.0, that the Republicans didn't all play in the sandbox very well.
Yeah, I mean, maybe it'll change once he's in office. We kind of
Yeah,
have the lame duck or whatever,
yeah.
and Biden's not necessarily like driving much on his own right now. So
Yeah,
maybe that'll change once he's in office. And there's
yeah.
still a lot of nominations going on.
I am shocked to learn that Biden had some cognitive issues. I mean, everybody knew that that was the case, and yet somehow this emperor has no clothes. The kids say emperor has no clothes, which is just about everybody kind of watching him trip and uh, you know garble up his words. So we all kind of knew it, and yet somehow or other, um, the myth was created that no, he has plenty of good days and plenty of good moments, and so he can keep it going. But what a mess. I think the last time we had a mess like this was Woodrow Wilson when he was incapacitated and his wife ran the country. Uh, I mean, that's okay, I guess. Jill Biden ran the country there for a while, and some people thought she did a good job. Anyways, we don't have to get into that. Eric, what about the economy? Let's talk about the economy, and then a little bit more about inflation. I see that there's one of our competitors out, not really a competitor, really. Torsten over at Apollo is made a little bit of news this morning saying that there's a 40% chance that the 10-year bond yield will get over 5%. Um, and he had something else that was kind of 40%-ish, but maybe the inflation would be more of a problem. But he was definitely out there with a pretty radical call.
Yeah,
Uh,
Fed hiking was another 40% one, I
oh
believe.
yeah. That's right. So yeah, I think he's out there all by himself. It's an interesting call. It's a contrarian call. So I like contrarian calls, but we have to believe him to make those calls, and it's a little bit out there for us. But what are you thinking about that?
Yeah, and I kind of thought, like, let's say core PCED gets to 3% or something and it starts to rise. I could see the odds of a rate hike kind of making their way into the futures market. I don't think they will. There really have to be a huge oil spike or something, or goods
Yeah.
deflation would somehow have to really reverse. Because whether it's neutral or not, I mean, it's not like interest rates are low, right? They could kind of keep them here and argue that they're restrictive, and I think the market would take to that. But yeah, I don't know. Could the yield go above 5%? Like maybe 40% seems
Yeah, I
okay.
mean, it was interesting on CNBC this morning. Zaros, I guess he's at Jefferies. He's the strategist there. Was I think was asked about Torsten's uh, forecast, and his comment was, "Well, he said 40%. 40% is what you put out there, so that you can't be wrong. If it doesn't go there, well, it was only 40%. It wasn't 50%. And if you get it right, say, well, it was going in the right direction. So I thought that was an interesting insight on the forecasting business, and I guess we can all be accused of playing that game. But uh, Zaros was saying that he thought the exact opposite. He thinks we're going to go back to 2018, 2019, back down to 2%. So a lot of controversy out there, and I guess a lot of it depends on what the so-called neutral rate is, which you and I and everybody else, if you ask people to tell the truth, the economists of all stripes would tell you that you can't measure it, and even if you could measure it, you don't know that it's going to stay there. And if and of course, both fiscal and monetary policy could very well change the real rate, and of course, more fundamentally, productivity could change the real rate. All kinds of variables could affect the real rate at which nirvana occurs. So it's a pretty useless kind of exercise. At the end of the day, I think it just depends on how, if the economy is doing well, inflation is moderating, then interest rates are where they should be. And that's our view, is that interest rates are, in fact, where they should be, and that the economy is going to continue to grow, and that the growth will be boosted by productivity, and that's not necessarily just a forecast. So we already see evidence of that actually occurring. On inflation, I think again, we have a fairly consistent base case with the roaring 2020s, with that if productivity continues to make a comeback, that helps to keep a lid on unit labor costs and keeps things working pretty well. By the way, while Eric and I are having a little fireside chat here with each other. We'd like you folks. There's a nice group here of 80 folks who've joined us, and so we'd love to get your questions. You can even ask us what we're doing for the holidays. Eric, I've got my wife is French, and there's her mother is here, and her mother just turned 80, and my wife surprised her by bringing over one of her sisters from France with her daughter, and then the other sister lives down in Georgia. So we had a little surprise. I was hoping she wouldn't keel over from the surprise, but she took it really well, and so she was very happy about that. And uh, since there's a French influence here at the Ardeni family, we're going to have our Christmas meal tomorrow night, Tuesday night, and that will be beef Wellington. So, we've got some haute cuisine over here at the Ardeni house. We celebrate both Hanukkah and Christmas, so we wish you all you folks that, just so we don't forget to mention that. Eric, we're getting some questions. Why don't we take them? I think we'll skip the charts, especially since we don't have any, in the sense that we didn't do a morning briefing for today. We decided to uh, recharge our batteries. Why don't you take it away, Eric, and see if there's some questions out there we can respond to.
Thank you. All right. So this one is, has a January sell-off gotten to consensus? And what is your favorite New Year's beverage to celebrate?
I like Kir Royale. Champagne with a little bit of cassis. Can't beat that with a little bit of caviar on the side. That makes the new year for me. But with regards to what was the other question I got distracted by
um,
thinking about the food.
has a January sell-off gotten to consensus?
I don't know, Eric. What do you think? I mean, it is kind of consensus, but then the market's not cheap, and we have seen some disbroadening of the market, right? I mean, it's become a little, somewhat less broad. I mean, technically speaking, it would be a healthy thing. It would be kind of predictable from a contrarian standpoint. I mean, are we at the point in these markets where to be a contrarian, you have to bet against the contrarian view? So if the contrarian view is viewed to be that the market's going to have a correction in January, then of course the correct answer or forecast is no, that's not the case. It's just going to melt up further. So I guess that's a possibility, but I seriously doubt. When I didn't look. Do you know when the next FOMC meeting is? Is it January or February? It's probably late January.
January. And
Yeah,
then
late
there's
January.
January's, yeah,
Yeah,
December CPI will be before
yeah.
it.
I
So we'll have
gotta
that.
believe they're going to pause. I gotta believe they're going to skip. And if they do, at his presser, Powell's going to have to explain that. And so, no matter what Goolsbee and Williams and some other devs might say, I think a pause would be, I mean, I guess I will be talking about, is it a hawkish pause or a dovish pause? So, I mean, this stuff can really get you all tongue-tied. But it's a good question. No, we're gonna stick with the idea that there's going to be a correction, but maybe it's just hopeful, wishful thinking. I wouldn't mind an opportunity to buy more stock cheaper. Any thoughts you want to add to that, Eric?
Yeah, I don't know. I think the selling and rebalancing argument makes sense. And there's not a lot of like catalysts right early in January other than that. So like CPI is not till mid-month. You won't get earnings from Q4 till later on. So I don't know.
Well, I want to be like the second week in January. We'll start to get the earnings, and
Yeah, it'll
so
start trickling
yeah.
in.
So more than trickling in the sense we always start out with the big banks,
Hmm.
and it's hard to see why they would disappoint since things have been going smashingly well in
Yeah.
the economy. But then maybe the big action is going to be tech a couple weeks after that. Um,
Yeah. Nvidia coming so late always makes earnings season kind of interesting
yeah,
in this market.
go ahead.
Um, let's go to To a multiple question. So you had mentioned you think the S&P will end 2025 at 7,000. If we're starting at six, that means the market will rise about 16%. So that is more than earnings estimates for all of next year. So do you think we get multiple expansion or that earnings are better than expected?
Well, when we do it with forward earnings. So forward earnings are looking forward. They're time-weighted average of analyst expectations for this year and next year. And Eric, I looked and compared our forecast to the Bloomberg strategists, and I asked Bloomberg to include us there, but they have a legacy issue that they have a lot of they prefer just to stay with a sample of strategists they have. So they're obviously all from the major houses. But we are with 7,000. I think there's one other that beats us with 7,007. Somebody actually put in a forecast of 7,007. So I guess we have to start thinking along the same lines as playing a little poker with that number. I know some people are saying we should get rid of this game, but I don't know. We have fun playing it, and it kind of helps you focus on the direction in which we're looking at things. But yeah, I think that when you look at forward earnings, by the way, we're using $285 a share in 2025, which again I compared to the Bloomberg survey, and we're the highest for 2025, which is consistent with the fact that we're sticking out there with roaring 2020s, and there aren't too many other people that are drinking that Kool-Aid with productivity and the whole story. So no, we can get you to 7,000 with a 21 multiple, maybe 22.
All right. This one is how high can the 10-year real rate go before risky assets take a hit?
So I guess he's talking about or he or she is talking about the 10-year tips.
I guess, yeah, we can talk in nominal terms too, just about the
Yeah.
10 years.
What do you think about the tips? So let's start there.
Yeah, I don't know. They got up to they breached 2.2. I think two is like normal, you know what I mean?
Yeah.
That's pre financial crisis, it's pre QE, so somewhere around there.
Yeah.
Um, but like if growth continues on this like 3.5, it hits 4% next year, maybe the tips yield is higher and it's for good reason. So I don't know if that weighs on tech necessarily. I think that argument is kind of faded after the
Yeah.
past couple of years.
Yeah. I mean, basically, we're comfortable with 4.5% plus minus 25 basis points
Yeah.
at this point, kind of where it was before the great financial crisis, consistent with our view of whatever the neutral rate is. It's higher than Fed people are thinking, and it's probably close to where we are now. So rates are kind of where they should be. Um, I have to remind everybody once again that we think the idea that you somehow that there's a real neutral federal funds rate is bizarre. I mean, to adjust an overnight rate for a year-over-year inflation rate and say that's our star is just really strange. So, anyways, that's my pet peeve. Go ahead, Eric.
This is an interesting question, talking about, the economists on or at the Fed, claiming or thinking Trump's policies will be inflationary. He says, the question is, will Trump veer away or modify those policies if they do indeed appear to increase inflation? I actually think one of the interesting things in the summary of economic projections released at this FOMC was there was a big shift in for inflation, but that was about it. Core PCE for 2025 was raised from 2.2% to 2.5%, or at least the median expectation. And a lot of participants suggested that they were really uncertain and that the balance of risks was weighted higher for inflation. But growth and unemployment were mostly unchanged. So people kind of thought maybe this is pricing in less immigration or deportations and tariffs as raising the risk of inflation. But then Beth Hammack's dissent statement specifically said, I raised my inflation projection because of the prevailing, strength or stickiness of inflation. So kind of countering that. So it's kind of a question mark how much the FOMC is actually worried or
Yeah.
modeling tariffs.
Yeah. Well, yeah. Both of us like to keep close tabs on what the competition is saying. I mean, our business is a competitive marketplace, and so one of the ways you try to provide a good service is by being aware of what your competitors are doing and try to do better than they are. So we are very plugged into the to our competitors. And again, I was watching Zaros. I think I'm pronouncing it right. I apologize if I don't. From Jeffries, take the posture that deregulation, that of all the things Trump is about to do, deregulation is the biggest deal, and that will be very disinflationary. And I think we kind of agree with that.
Yeah.
The tariffs is a tough call, but if the tariffs are imposed and the dollar goes up and offsets that, then foreigners will pay the price. They'll get fewer of their own currency because the dollar will be stronger. If the dollar remains flat or goes down after a 10-20% tariff increase, then Americans will pay it, and that would be inflationary. So there is the issue of how big an impact this would have and what the currency is going to do. The deportation, my sense is that, just the way Biden basically nullified everything Trump had done and then issued statements along with, I think Kamala did as well, basically saying, come one, come all. Well, they all did. So they went to one extreme, and now clearly Trump has to go to the other extreme and try to convince people that are walking towards going north from Latin America that don't bother because we're going to just send you right back. But I think in terms of resources and abilities to deport, and priorities, it's going to have to be the criminals, the bad folks. Eric, as I've said before, a good place to vacation or even move to these days is Venezuela because they got no crime. They said all the criminals up here. But seriously, folks, I mean, I think that's where the focus is going to be. I think on balance, it's kind of a gut feel more than it is science. I think on balance, all we can everybody takes a position. And I don't know about you, Eric, if you agree with it. I think you do. That on balance, it should be disinflationary, but we'll see how that plays out. Why don't we take one more, Eric?
Um, we've talked about this before, but it might be good to recap. Thoughts on the Buffett ratio?
Yeah, well, the market has a valuation problem for sure. The Buffett ratio last we looked was 2.9. Buffett many years ago said he's uncomfortable when it goes above two, and I think that pronouncement goes back to when it got up to two in 1999. I think he said when it gets around two, that's too high. And he has been raising some cash here, though. I saw a story that he also bought some stock recently in the sell-off for the other day. So he's still buying. He's not just selling. And he is looking for opportunities. And maybe he thinks there's going to be more opportunities, and he might be right. That we're not dismissing a significant correction, given the valuations are relatively extended. But we've also made the point that for the past 3 years, we've had the most widely anticipated recession of all times. It didn't happen. And the market may have kind of settled down into thinking, well, if we couldn't get a recession when the Fed raised interest rates from 0 to 5.25, 5.5%, what's going to cause a recession between now and the end of the decade? Well, it could be tariffs, could have Smoot-Hawley, I guess, but that seems at this point something that we are in the markets aren't buying into. Uh, Geopolitical crises, well, we've been there, done it, and it hasn't caused any problems for the economy or the stock market. Deficit, debt crisis, maybe. But at this point, I think the market's kind of settling. And then we agree with this notion that there won't be a recession between now and the end of the decade. And if that's the case, then that gives the market, the economy, a lot more time to grow earnings into these valuation multiples. So the longer you think that the economy can grow, the higher valuation multiples you're willing to pay. And we would argue that that actually makes sense. If you think there's going to be a recession in 6 to 12 to 18 months, then these multiples are ridiculous, and the market's going to have a significant correction. Eric, and everybody, happy holidays to all of you. Thank you for joining us. I don't know if we'll do this next Monday. It's kind of fun when you're kind of relaxed and the markets aren't doing anything really wild or crazy. So maybe we'll, if you're around, maybe I'll be around. So we'll, if you guys get an email from us saying there's a call, then tune in if you have time. But again, thank you all very much. Happy holidays to you, Christmas and Hanukkah, and Happy New Year's. Thanks, Eric.
Thanks, everyone. Happy holidays.